welcome back to another episode of Finance in 15. I'm joined today by Josh and Melissa Stein. Thank you guys for being here with us today.
Thank you, Steven.
Absolutely. Between a volatile policy backdrop, fresh tariff headlines, and the Fed's big December decision to cut 25 bips today, couldn't have picked a better week to talk about what's really moving the economy and market. So why don't we kind of just dive in with, and start with the state of the economy. Josh, would you kind of like to talk about maybe growth expectations, maybe some drivers of slowdown and kind of what's going on?
Sure. So year to date, most of the major indexes are positive. We have the NASDAQ over 20%, and international markets are still over 20%. The S&P 500 isn't that far behind, and fixed income is up as well. So despite a lot of the volatility we've seen, overall the markets have been fairly resilient. November was a bit of a slower month, and we saw a fair pullback in some of the more volatile asset classes, in particular technology. But in general, despite a lot of the headwinds that you had already mentioned, inflation, tariffs, interest rates, the markets have kind of maintained a consistent growth trajectory for the year. So I think all things considered, most investors are probably feeling pretty good, at least about their returns. And of course, the future is always in question. But for 2025, it looks like it's going to end up being a year of positive returns pretty much across most major asset classes.
Now, I feel like the boy who cried wolf talking about recession. Melissa, any thoughts on the outlook looking into 2026? If a recession's on the horizon, we heading towards one? What's your thoughts on that?
Well, of course, nobody really knows if we're heading towards a recession. Oftentimes we're already in one before we know we're in one. We do see signs of the economy slowing down. I think just because the markets are hitting all-time highs doesn't mean they're going to go down. I think sometimes that's a perception that clients have. It doesn't mean it's a bad time to invest. In fact, we find that just investing consistently over time gets you the best result. But it does look like we might be facing some headwinds coming into next year. We've had some geopolitical tension for some time. We've been in elevated interest rates and inflation for some time. That's absolutely going to cause things to slow down. We've also seen some slowing down in consumer spending as well as in the labor market. So these are things we're keeping our eye on, we're concerned about, but we're not necessarily thinking we need to completely pull back on equities either. So we are taking some steps that we'll talk to you about to mitigate some risks and to I would say, be more conservative. But recession maybe not on the horizon, but definitely things kind of heading, to slow down.
Gotcha. Now maybe talking about inflation, obviously headline inflation, 3.3, 3.5 year over year. How does inflation get impacted by some of these rising tariffs and other potential government stimulus kind of interfering with spending and everything?
So, I think right now the Fed's pretty divided on, how they feel about interest rates. There's not a clear consensus, so we have a little bit of uncertainty there, and we know markets don't like uncertainty. So, we're going to keep our eye on that, make sure we're hedging our portfolios any way we can to, prepare for what's coming down the road. Of course, we just don't always know exactly what's coming or when, but any good with portfolio should be able to navigate those waters.
So today we had the December Fed meeting. They decided to cut 25 basis points today. Obviously, there was some internal disagreement about if they should have cut rates or rates low, etc. Josh, you want to chime in about that announcement today?
Yeah, this was a very divided Fed meeting. So there was a pretty big spread between the different board members, some voting for a larger rate cut, some voting for no rate cuts at all, and some actually coming out and saying that rates are already too low. But the Fed did end up cutting a quarter basis point, as you said, bringing down the Fed funds rate to 3.5 to 3.75%, with the expectations, of course, potential expectations of one additional rate cut next year. We don't know if that's going to happen, certainly isn't guaranteed, but that's kind of what they alluded to. The Fed also brought up some data points for inflation, saying that their inflation expectations are going to be down just a little bit from their last print, and that GDP should be up a little bit, which both of those are reasonably good things, and somewhat maybe indicative of them not continuing to cut rates. But it definitely seems like there's a pretty broad opinion right now as to where should the Fed funds rates be. And we've talked about this in other Finance in 15 meetings with regards to like kind of how arbitrary the Fed funds rates are right now. Like, what should they be at? We know they probably shouldn't be at zero where they were for a long time. But what is the right number? Honestly, I think one thing we can take away from this is they don't even necessarily know. So there's probably going to be a little bit of trial and error here as we see how the economy reacts over the next several quarters, and how inflation reacts and productivity for the Fed to really get more data as to figuring out like what the new kind of baseline interest rate environment should be.
Well, and not to beat a dead horse, but we've been talking about this for probably 5 years now, which is the Fed just fundamentally changed how they set rates in 2008. And we don't really know what that means. I mean, they essentially set the rates. So trial and error, right? There's no efficient market or anything determining that. And we don't always know what that means.
Not maybe the best thing to have such a divided committee, but also at the same time, that stimulates conversation, discussion, and hopefully, even if they're wrong, they're maybe not too wrong, and if they're right, obviously that's good too. So it'll be interesting to follow. In my opinion, I think probably one more rate cut isn't the worst thing in the world, but at the end of the day, it's going to, I think, be more a function of how do we keep growth in the economy, how do we keep GDP moving in the right direction, and still keep a stable jobs market and not get into an issue where we have inflation continuing to creep up. The latest report seems to indicate that could potentially happen, and that's probably a good thing for the markets. It's probably a good thing overall for the economy, but who knows? These things tend to change, and with the recent data being a little bit stale and maybe not the best given the government shutdowns, we could see some very conflicting information next time these reports are run. So strap in, we'll see.
Certainly, absolutely. Any other comments?
No, I think Josh is right. I think first quarter we'll have better data and probably be able to continue to evaluate that, which is what we always do because we just have to evaluate as the data comes. Certainly this rate environment can be conducive, for certain asset classes like small and mid caps and things like that. So, I mean, we'll look at how that could positively impact, some of those asset classes in your portfolio.
Perfect. I think that's a good jumping off point to maybe the U.S. stock market outlook. So obviously tech still leads, but we're starting to see a broadening on the different sectors of stocks. So Josh, maybe want to talk about some strong performance from the equity sides.
Well, the major market movements that we've seen here domestically, at least throughout the entire year, has been heavily driven by the technology sector, and in particular the companies that kind of have focused and been front runners in the AI space as well. They are outpacing the S&P performance significantly and really accounting for much of the overall S&P 500 performance, which isn't necessarily the best thing, right? It's probably maybe more healthy to see of the 500 companies in the S&P 500 more than just 7 or so companies kind of leading the way. And actually, when you really start to peel back the layers of the onion, you'll find a very abnormal range between companies that either are down for the year or far below the S&P 500 average compared to kind of the AI and the big tech companies. There's been a lot of questions about AI. We certainly are taking that very seriously, and we've talked about AI in the past in these and kind of our opinions as far as how they should be included in investment portfolios. And certainly we continue to maintain those positions. But one thing that I think is important, and it kind of backs up everything that we've talked about now, is coming off of such a good year, And with some questions about the certainty of that continuing into next year, it isn't necessarily a bad idea to take some of those chips off the table. And while we're not necessarily reinventing the wheel or deviating from our kind of core fundamentals, we are in the midst of a asset class rebalance where we're taking some of the winners, reducing our exposure to them a little bit, and kind of broadening those dollars out to some of the other asset classes that are still growth oriented, still very much in the equity space, but maybe just aren't quite as overexposed to some of those areas that we benefited from all year. So that's one of the kind of major themes of our latest rebalance is sell some of the things that went up a lot and replace it in some of the more broader places of the markets. And if we kind of see this reversion back to a more broader market growth opportunity rather than very isolated, that can be very, very beneficial.
Well, we've had so many like concentrated returns in like the top 7 or 10 stocks in the S&P 500 for so long that we've continued to look for ways to reduce risk to that, because that historically doesn't always indicate, that it's going to continue to do that for the near future. So, I mean, that high stock concentration is something that we've been concerned about for a while.
So on the topic of AI, there's been some articles saying that it's a bubble and it's similar to, 2001, 2002. What are your thoughts on that?
Well, we don't necessarily feel that it's a bubble per se. I mean, we are keeping an eye on that asset class because, obviously there's been tremendous growth there. For me, I think where the real difference is in 2001, 2002, these were companies that were being formed that were not they didn't really have any proven like profitability. And the issue then was how they were being valued. Like very high values were being assigned to them when they didn't actually necessarily have anything backing that up. That's not really what we're seeing with the AI revolution today. It's more along the lines of, we can see, like, I think everyone's noticing how it's changing the way we live and what we do, and it's changing business. So there is actually a value there, and these companies aren't necessarily being overvalued. And I think, when we look at the Industrial Revolution, it took 100 years to happen. AI revolution's probably going to take 10. And we definitely want to make sure our clients are participating in that in a really conservative and diversified way.
So maybe if we switch gears a bit and talk about global equities. Obviously, global markets have outperformed U.S. year to date. That is led by a strong emerging markets. But there's still some risk there, wouldn't you say, Melissa?
Well, there's geopolitical risk, there's trade tensions. Of course, we have the tariff policy, which is it's a big uncertainty. International, we think in part has done well because of the decrease in the dollar, and that's just something that typically the international and emerging countries are going to benefit from. Is this something that's sustainable? We don't necessarily know. For the last 20 years, obviously domestic stocks have outperformed these international equities, but there are definitely pockets of opportunity, and there always are going to be there. And there's definitely pent-up demand and a lot of room for continued demand and to see increase in those countries. But this is why we stay diversified, and we always want to participate in a diversified portfolio in international markets as well. So I certainly wouldn't say we're overweight, but we do have an allocation in international equities in our portfolios, and we will continue to do so.
Josh, want to add anything to that?
Yeah, I think it's more a function of what's the opportunity with regards to domestic stocks. Do we really think that international is going to outperform the U.S. year over year moving forward? I think most of us would say probably not. There's a lot of great international companies, but you have to know how to go find them because for every one, there's many more that are probably less attractive. So when we do own international, we want to make sure that we're in the right places. We tend to keep a more modest allocation towards international, but it's still certainly worth having a piece of the portfolio carved out for something else besides just domestic.
Well, and in general, when we own that asset class, we want to use more skilled managers because the stock selection is just more important there. So.
Maybe switching gears, also important, the bond market. So obviously treasury yields have eased from recent highs and market conditions have stabilized. Obviously, we just had a rate cut today. What does the outlook look like for the bond markets? Maybe talk about some spreads.
Yeah, so that's a good question. Thank you, Stephen. I think this fallacy that when the Fed cuts rates that all of a sudden all the rates corresponding to that drop. And one thing that we've really seen is that's absolutely not the case. So where the Fed has cut rates several times this year, 10-year treasuries have really not moved much. Mortgage rates haven't really moved that much, and we're starting to kind of experience this more detached interest rate environment where the Fed can lower rates and short-term things like money markets, savings accounts, CDs, those types of rates will drop accordingly, but longer term rates are really more a function of how the secondary market prices them, and they're going to be more controlled by expected inflation over time, long-term interest rates, all sorts of other factors, and we're not really seeing quite as much of a move. So although I think there's still a lot of opportunity in the bond market, in particular in high quality debt, because we're not really getting a lot of interest rate risk, where if the rates do move, those bond prices could be adjusted. But also at the same time, we need to make sure that we're owning the right bonds and at the right duration. So we tend to be a little short of the aggregate bond index as far as our duration on our portfolios, where the aggregate bond index is around 6 years of duration. We tend to be closer to like between 4 and 5. We like that sweet spot now. You're getting a little bit more interest for a little bit shorter term, but relative to extending that duration out, your risk is pretty low right now.
Well, the nice thing is for, looking at in the grand scheme of things for the last 20 years, I mean, the bond market looks attractive right now. I mean, for very little risk, you can have a decent yield on your portfolio, and they seem to be also a good stabilizer in the portfolio. So this is the first time in a long time we've had the opportunity to really have higher yielding bond portfolios. And for our clients who are seeking income and more stable portfolios, that's really helpful.
It is.
Any interest in high yield debt, anything like that, given where the spread is between?
Yeah, spreads are really tight right now, so you're just not getting rewarded for taking that extra risk, which is why we're focused more on the intermediate term, higher quality bonds, as we just mentioned, especially if we do think things are slowing down. I mean, we always want to be in high quality.
So given all that we've just talked about and discussed, what kind of adjustments this quarter did we make on the equity piece, Josh?
Well, like I mentioned to you before, we are taking some of the chips off the table in some of the asset classes that have outperformed or performed better this year, starting to spread those around to other broader areas in the stock market. Our actual stock exposure isn't changing. So if you're in a, let's just say 60% stock portfolio, it's still maintaining around that type of asset allocation. We did make a few changes on the international side just to kind of make sure that our exposure is where we want it to be on the international side. For some of the more growth-oriented portfolios, looking at some individual sectors to try to broaden out a little bit, whereas we may have used the S&P 500 for exposure to that, we're kind of moving into some other sectors to just try to spread out some of those dollars, opposed to being so heavily concentrated in some of those asset classes that have just kind of seen this massive concentration of returns and performance. On the fixed income side, we're still looking at quality. So we're making sure that our bond portfolios are adjusted to ensure that we're kind of matching the best yield for the least amount of risk, per se. Nothing outrageous is changing, but we still have some hedges on the equity side to manage some volatility on the downside, and maintaining our kind of target for stock bond mix. But we're making some important adjustments to ensure that the risk inside the portfolio doesn't get out of whack with where we've seen growth.
Right, and then just to add to that, adding a small gold position
Yeah.
just as a non-yielding asset, kind of a hedge to, inflation and some geopolitical stuff as well. But again, nothing overbearing.
Well, and that really just supports the case for the fact that we've been evolving our asset allocation strategy over the last 10 or 15 years to really match like the increased correlation between other asset classes. And we want to employ things that are going to be either negatively or not correlated to other asset classes to protect the stock and the bond portfolio. So we've continued to employ like alternative asset classes to help stabilize portfolios and give us additional diversification that we just simply can't get from only managing stocks and bonds. And I think that's an important distinction because we've had to continue to do that to be able to help our clients manage risk.
That is all for today's Finance in 15. Thank you for joining us. We'll see you soon.